Hello and welcome to Own Your Retirement. My name is Albert Lalonde from Kaizen Financial. If you'd like more information about what you hear during our show today, give us a call at 586-752-7008. Or as always, visit us online at www.kaizenfinancialinc.com. That's Kaizen, Kaizen. And while on my website, click on my podcast page to check out our past shows and also to subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. All right. Both life insurance and Roth IRAs have the potential to provide you with tax free income during retirement. But the path to utilizing that tax free income isn't without possible traps and roadblocks. So, during our show today, we're going to discuss the potential drawbacks of both life insurance and Roth IRAs and whether one, both, or neither would be a good fit for your financial strategy. But before we begin today's chat, let me introduce my favorite co host whose one in a million voice comes to us loud and clear each and every week like a big death benefit. Hey, what we doing here, Tony? How we doing, buddy?
Wow, I don't know if I've ever been associated with a death benefit, but yeah, wow,
You
your
have a million
favorite
dollar voice, buddy.
yeah, your favorite co-host. I like that line too. I'm your
There
only
you go.
co-host.
I know. That's why you're my favorite. Good thing.
That is good. That is funny. I'm happy to be here as always, Albert. You know
Good.
that.
Yeah,
Yeah.
of course, of
Yep. And
course.
I've had a great week. I know you've been busy.
Mhm.
We were just talking. You have a charity golf tournament coming up. That's always a big
Yes.
deal, and
Yes.
everyone always looks forward to that, right?
Yes, we have a waiting list already. That's
Yeah,
how tactic
that
it, so it's
that's
good.
I like that. I like that.
Mhm.
Well, it sounds like you've got a good show lined up. I mean, obviously, I think I know a fair amount about both life insurance and Roth IRAs, but I
Mhm.
wouldn't want to do anything with either one without working with somebody like yourself. And it sounds like you might have some surprises in store for all of us regarding these things. Where do you want to begin?
Let's frame today's conversation around a U.S. News and World Report article titled Life Insurance versus Roth IRA, which offers better retirement security. So, in that article, planning for retirement isn't always straightforward. And let's be honest, it can feel overwhelming at times. Now, a lot of people spend years fine tuning their investment mix with the right balance of stocks, bonds, cash. But one thing that often gets overlooked is where those assets are held from a tax standpoint.
Mm.
Now, believe it or not, taxes in retirement can end up costing more than healthcare. That's why I sometimes call them the silent budget buster. Now, withdrawals from certain accounts can trigger income or capital gains taxes. And if you're not careful, they could even push your income high enough to raise your Medicare premiums. So, having a tax free income stream in retirement can provide you with the income you need to enjoy your ideal retirement. So, Roth IRAs are a popular option. It's been talked about, in fact, for quite a few years now.
Yeah.
But another strategy many people don't think about is life insurance, which can also offer a tax free income in retirement. And each has its pros and cons, and choosing the right one for you, well, it depends on your goals. Many financial service professionals agree, though, that for a lot of people, one option may be the better place to start.
Sure. And choosing between life insurance and a Roth IRA, or possibly utilizing both,
Mhm.
that's a good topic to address with somebody like yourself, isn't it?
Oh, for sure. You definitely want to talk to a financial service professional. Now, let's take a moment to break down one of the most popular tools for building tax free income in retirement, the Roth IRA. Um, at its core, a Roth IRA is a retirement savings account that you fund with money you've already paid taxes on. From there, you can invest those dollars. And here's the potential big win. When you retire, both your original contributions and the earnings can come out completely tax free. Now, there are a few rules to keep in mind. In 2025, if you're under age 50, you can contribute up to $7,000 a year. But if you're 50 and older, you get to put in a little more, in fact, up to $8,000 for the year. But not everyone qualifies, and there are income limits. So if you're single and earn more than, let's say, $165,000, or let's say you're married and filing jointly with income over $246,000, you may not be eligible to contribute directly to a Roth IRA. And there's one more important age milestone to remember. That's 59 and a half. We've talked about this in previous shows. That's when you can start taking tax-free withdrawals. If you pull money out earlier than that, you might owe income tax and possibly a 10% penalty unless you meet one of the exceptions. Now, with that said, there is some flexibility, especially when it comes to accessing the money you've put in. One of the nice things about a Roth IRAs is that you can always take out the amount you contributed. So your actual principal, tax and penalty free when you do it. So if you put in $7,000 and let's say the account grows to 15,000, you can still access that original $7,000 without any tax consequences because you already paid taxes on those dollars, Tony.
Well, yeah, and it's like you always say, IRAs are great, and there's a lot of great advantages. I mean, it grows tax free, it all comes out tax free.
Mhm.
However, a Roth IRA isn't necessarily going to be the right move for everybody out there, and it that makes it so important to go over the strategy with a financial services professional,
Yeah.
someone like yourself, before you make any final decisions about a Roth, right?
Definitely, because there's other choices too. So let's talk about using life insurance. It's
Ah,
another
okay.
retirement income strategy that often flies, I should say, under the radar.
Yeah.
We call these things LIRP, life insurance retirement programs. Now, most people think of life insurance as a way to support loved ones after they're gone. And that is true. It's a very powerful legacy tool, but it can also play a surprising role during retirement. For example, some policies let you tap into benefits early if you're dealing, let's say, with a chronic illness or need long term care. Others are used specifically to create an inheritance, which may free you up to spend down your other retirement assets with less worry. And here's where it gets even more interesting. If, let's say, you own a permanent life insurance policy with cash value, it can potentially become a source of tax advantage income in retirement. Now, not all policies work this way, so it's important to know what you have and what you're considering. But one option that some financial services professionals favor is variable universal life insurance. It lets you invest in things like stocks and bonds, just like with the Roth IRA. Of course, that comes with the market risk, so it's not for everyone. But other financial service professionals also lean towards what we call whole life policies, which tend to offer steadier growth and reliable dividends from multiple companies. Either way you go, the potential tax benefits are appealing. Now, depending on how you access the funds, that cash value can grow tax deferred or even come out tax free.
I like the sound of that, tax free. That's a
Mhm.
really good one. Now, we've been talking about a lot of different things here, Albert, and I think it is a good idea to work with someone like yourself. You're offering a no charge, no obligation consultation, correct?
Yes. You know, folks, if you want to learn more about how you can be more tax efficient in your retirement, please go to my website, kaizenfinancialinc.com, Kaizen, or call my office, 586-752-7008. Set up a meeting with us, and we will go over all of your retirement objectives, your goals, and especially looking at where your taxes lie in retirement and thereafter.
Yeah. Yeah, I think that's great. Now, during the show today, you've been talking about how life insurance and Roth IRAs may help people create reliable retirement income.
Mhm.
And at the same time, both products can come with drawbacks depending on your overall financial strategy, where you're at, and what your long term goals are at. And that's something you help people you work with find out and figure out. What else do you have for us on this one?
Well, we're going to stay with that same U.S. News and World Report article titled Life Insurance versus Roth IRA, which offers better retirement security. It's got some other details that I want to talk about and how to create retirement income using life insurance. So let's talk about how life insurance can actually be used to generate that retirement income, because this isn't your traditional just in case strategy. Now, typically, if someone's using life insurance this way, they're taking out loans against the cash value of a permanent life insurance policy. Now, these loans usually don't need to be repaid during your lifetime. Instead, the outstanding balance is simply deducted from the death benefit when the policy pays out. Now,
Mhm.
whatever's left after the loan is settled goes to your ears. So, now that might sound pretty straightforward, but there are a few important pieces to understand before using this strategy. First, this kind of approach isn't for everyone. If, let's say, you're in a low tax bracket now and expect to stay there in retirement, well, life insurance might not be the most effective or efficient route. And to make this strategy really work, you've got to start early because it takes time for that cash value to grow in that policy. Now, even after 10 years, many people find the cash value hasn't grown much more than what they've paid in premiums. That can feel frustrating, especially when you factor in the fees.
Okay, yeah, the fees, you wanna be aware of those, and what are some strategy scenarios that people need to discuss with someone like yourself?
Well, let's say to get the most income out of, let's say, one of these policies, you also have to actively manage the death benefit. And that's a step, well, let's just say a lot of people overlook.
Yeah.
You want a policy that's built to be lean and efficient. So, if we talk about a variable universal life policy, for example, there are two parts: investments and the insurance. Now, the goal is to minimize the cost of the insurance portion so you don't eat up your growth with unnecessary charges. But you also need to be careful not to violate the IRS rules. See, there are regulations that govern how premiums, cash value, and death benefits must be balanced. If you cross certain thresholds, your policy could be reclassified as what we call a modified endowment contract, or a MEC. And that means the gains could lose their tax advantage status, Tony.
Wow, and that would be a costly mistake, and
Mhm.
you don't want that. So when it gets down to decision-making time, what are some of the key things we need to bear in mind here?
Yeah, great question. So, when we're looking at options for generating retirement income, one question that often comes up is, should I start with a Roth IRA or look into a life insurance? Well, in many cases, the article explains that financial service professionals suggest starting with a Roth IRA. It's straightforward, flexible, and typically low on fees. Plus, it's easy to open and manage one through a major online brokerage. Now, if your goal is tax free retirement income, a Roth IRA is a smart and accessible first step. Now, life insurance, though, can also be a powerful retirement income strategy, especially for high income earners who've already maxed out their Roths or aren't eligible to contribute because of their income limits. One potential perk of using life insurance is that you don't have to wait until 59 and a half to access the funds. But the trade off is that life insurance strategies can be more complex and more expensive to set up
Mhm.
and also to maintain. So that's why some financial professionals don't necessarily see it as either or. Roth IRAs and permanent life insurance can actually complement each other. It all depends on your overall financial picture, your income, and then what kind of flexibility you want in retirement.
Right. You want to have that flexibility and work with a financial professional like yourself, who's well versed in both of these options to
Mhm.
have money in that tax free bucket. So you got to determine if and how a Roth IRA and life insurance policy can fit into your overall retirement plan. You're going to have to do the homework, right?
Yeah, yeah, you definitely have to. Now, let's talk again about, well, with this conversation of how you can save in both, let's say, a 401k and an IRA.
Mhm.
Another US News World Report article titled this time, How to Save in a 401k and IRA in the Same Year. We have some excellent details here. So, when we talk about building a solid retirement strategy, some financial services professionals encourage people to look at both a 401k and an IRA. So using both can be a smart way to grow your nest egg and potentially lower your tax bill along the way. But it's also important to know that higher income earners might run into some limits in how much they can deduct from both accounts in the same year, though, Tony.
Yeah, and that's where working with you and your team there can really help
Yes.
because you walk people through these rules, you help them figure out what they're eligible for, and you make sure they're getting the most out of every dollar they save. So if somebody comes to you, a new client comes to you, or a new person comes in, a listener to talk about IRAs, 401ks, and life insurance, what's likely to come up in that first conversation? What are you going to talk about?
Well, when someone first sits down with me to talk about, let's say, IRAs and 401ks or even life insurance, I first start by getting a clear picture of where they are today with their current accounts, their income, their goals, or any other concerns about taxes or market risk. Then we'll talk through the different types of IRAs that are available in 401ks and then how they're funded and what role they might play in their retirement income for the future. Now, if life insurance is part of the conversation, we'll explore whether it's about protection, legacy, or tax advantage income, or sometimes a mixture of two or three.
Hmm.
Now, I also like to walk through the pros and cons of each tool so they feel confident and informed. Remember, my goal in that first meeting is simple: to listen closely, ask the right questions, then begin building a strategy that truly fits their life and their values.
Yeah, I think that is key. And I know that you do that and you really love helping people here in the community with this. And that's why today you've been talking about life insurance, Roth
Mhm.
IRAs, and even saving in a 401k and an IRA in the same year. There are things people need to note. What's next with that?
Well, let's stick with that same new article on the U.S. News and World Report titled "How to Save in a 401k and IRA in the Same Year." First, let's talk about the contribution limits right now for 2025 and how to make the most of them. Now, if you're putting money into a 401k right now, you can defer taxes up to $23,500 next year. Now, if you're 50 or older, that jumps to $31,000 with what we call a catch-up contribution. And those between 60 and 63, there's an extra boost of up to $34,750 total. That's right. That's $3,750 more. That's a big opportunity to save, especially if your employer also offers a match. Now, IRAs work a little differently. The limit there is $7,000 or $8,000 if you're 50 and over. What's great is that these limits are independent. So if you're eligible, you may be able to contribute to both and potentially defer taxes on as much as $38,000 or more. And now, a financial services professional can help you figure out what you qualify for and whether your income affects your ability to deduct IRA contributions. For example, high earners with access, let's say, to a workplace 401k may see those IRA deductions start to phase out. But starting at $79,000 for individuals or $126,000 of income for couples. But if you're not covered by a workplace plan, then you may be eligible for the full deduction regardless of income.
Yeah, and those numbers aren't just guidelines, right? They're real opportunities to lower your tax bill. As
Yes,
I like to say, minimize that tax burden. That's the goal here.
big time.
And well growing the retirement savings, having that tax-free bucket. And that's exactly the kind of strategy that you help your clients map out each and every day, correct?
We do. And
Yeah.
and here's something a lot of people don't realize, Tony. You can save in both a 401k and a Roth IRA in the same year. And doing so can be, let's say, a smart way to diversify not just your investments, but your tax picture in retirement too.
Yeah.
You know, a Roth IRA is funded with after tax dollars. So you won't get a tax deduction when you contribute. But the possible upside is that your money grows tax free and withdrawals in retirement are tax free too. Now, that can be a powerful tool when you're trying to manage your income later in life. But now for 2025, if let's say you earn less than $150,000 as a single filer or $236,000 as a married couple, you're eligible to contribute to a Roth. The ability phases out as income rises And it's cut off at 165,000 for individuals and 246,000 for couples. But don't worry if you're over the limit, because there are workarounds, like what we call a backdoor Roth or even a mega backdoor Roth. Now, these strategies can open the door to Roth savings even for high earners, and that's something we help clients with all the time. Now, the real benefit of having both, let's say, a traditional 401k and a Roth IRA is flexibility. In retirement, you'll have options like pulling from taxable and tax free accounts to help control your income and your tax bill year by year.
Wow. So it's all about putting together a plan that's going to give you choices later. And that's
Mhm.
where a financial professional can come in, correct?
Oh, big time. And if you're not in a position to max out, let's say, both your 401k and an IRA, well, don't worry, because that's more common than you might think. But the key is to prioritize based on what gives you the most value right now
Yeah.
and then in long term. One of the smartest, I would say, starting points is your workplace 401k. If your employer offers a match, be sure to take it, guys. That's free money. Now, that match is essentially going to grow with yours, and we don't like to leave free money on the table. Remember that. At the very least, try to contribute enough to get that full match.
Yeah.
Now, after that,
It's huge.
it's worth comparing your 401k to what's available through an IRA. Now, we often help clients review the fees and investment options in each. But in many cases, IRAs offer more flexibility, lower costs, and greater transparency, especially if your 401k options are limited. And then if you left a job, rolling over that old 401k into an IRA, well, that can give you even more control and simplify your finances. We'll also want to make sure that we look at your current tax bracket and what it might look like in retirement. If you're in, let's say, a higher tax bracket today, and contributing a pre-tax to a traditional 401k could make more sense. But if you expect lower taxes in retirement, well, that deferral can really then pay off down the road, Tony.
Yeah. Well, and every strategy is personal, right? Everybody's situation is different, and you need to work with a professional to build a strategy that reflects who you are and what you want your retirement to look like.
Yes. Oh my
Yeah.
gosh. We 100%, you are so correct on that, Tony. We believe in following your values, your goals, your objectives. Whether you're managing IRAs, 401ks, or even exploring life insurance for retirement income, having a financial service professional by your side, oh, it makes all the difference. Okay. And today we covered contribution limits, we covered tax strategies, account comparisons, income planning. But your personal situation deserves personalized guidance, not just general. And if you don't already have, let's say, a trusted financial service professional, well, now's the perfect time to build that relationship. A strong partner can help you turn today's choices into tomorrow's financial confidence, Tony.
Yeah. Great discussion today. Do you have anything else before we close the show out?
Folks, if you want to learn more about how you can be tax efficient or how to plan your retirement income for today and tomorrow, visit my website at kaizenfinancialinc.com. That's Kaizen, Kaizen, or call my office at 586-752-7008 and discuss how we can answer your questions, address your concerns about saving for retirement, your financial strategy, or any other parts of retirement. Remember, it's our goal to help you prepare for the retirement you've worked so hard for so you can own your retirement.
All right. Thanks, Albert. And listeners, thanks for tuning in. That does it for today's episode of Own Your Retirement with our host, Albert Lalonde.
Take care.